Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Smash that like button. Subscribe if you already haven't. And just do a little disclaimer nothing should be construed as financial investment advice. Just my opinions and thoughts on the markets. Read more below. On the disclaimer, let's just get into today's stuff. I wasn't able to do a video yesterday. I had multiple, but. mm, if you actually look at the markets today, really bad news on the markets. Let's just do, Dow Jones down 427. Try to get a relief rally around 11, and then just there's someone selling. There is someone selling big time. The S&P 500, that's down. Same thing. They're bidding it up. And then around 11, another seller showed up. And there could be a bounce, but the S&P, look at this. We'll just do year to date. That is down 2.4%. And just do 5 year. The top was around February when they had that Trumphoria of 6,000. And if you look at it, just 1 month, it's down 5%. Still up over a 6 month time frame, but year to date, it's down almost 2.5%. It's not too much, but who knows? Let's go to max. This could, if you look at it right here, just looking at the max 6.1, it's really come down. This is a big thing. This is a big decline, and just if you look at this, this was 5836, so it's January low. It's broke down past January. It's December low. Now it's not below its November low, but 10 more points, and it's looking at a lot more new lows. So we'll see. I think if it has one more run, I think that's about it. But right now, with interest rates and the Fed keeping interest rates high, all rallies are going to be capped. As you can see, these rallies were capped. So you never know. If you look at it, July 17th, it went all the way down to 5,100, but then it came back up and eventually broke it. That could happen. It's still early, but the markets are not doing all that well. And if you look at gold is, I mean, I was starting to see crappy juniors do well. And so I think that might be beginning of the last leg. Was I remember the last leg up? But yeah, gold today was down a little bit. If you look at it on the five, this is I'm just GLD. 5 day, that's up 2.1%. 1 month, 1.83, and up 16% on the 6 month. Year to date, up over 10%. So it is greatly outperforming the stock market. And if you look at GDX, looking at GDX, this is also 1 day, it was down today 0.82, but 5 day up 6.5%. 1 month, it's up 0.56. 6 months up 13.8. Year to date, 21%. So 21% for GDX. I'm just going to do GLD on 10%. So the miners are outperforming gold. That is a very bull market and bullish sign. So I think gold's ready to break out and maybe anywhere between another year to 3 year run, but then I think it's over with after that. Could be, I don't know. As I said, let's get into the economic data, and this is one reason I think gold is continuing to do well. Now they talk about mortgage rates going down, but that was just a refi booms. That was 784. There's no new buyers into the market. So mortgage came down. People who bought, they were waiting to refi. But if you look at this ADP employment, only 77,000 jobs created, consensus 140. So way below the miss. There was an S&P Global PMI, but remember markets are forward looking, 51, ISM 53. But this is before a lot of these layoffs. So you can tell, government's laying people off, private sector's laying people off. Jobs are not doing well. If you look at Thursday, Challenger job cuts, 172, way above the forecast of 56, and way before trade balance, way out of whack, 131. That was before the tariffs. We'll see. Uh, as I said on this channel, I don't think much is going to be done. I think they're going to find out the hard way. The U.S. actually needs Canada and all Europe and everything. I don't think Trump's ego is willing to lose a trade war, so he'll, as you can see, quickly. I mean, the right says it's a negotiating ploy. I don't buy it, but anyway, initial jobless claims though, those weren't that bad. 221. Consensus was 235. But continuing jobless claims, 1897. Uh, and so inventories, that was just rushed before the tariffs, like the trade deficit. So don't make too much of that, just like the trade deficit. So tomorrow's non-farm payrolls. Uh, for some reason, I think this is going to surprise to the upside. I think it should go bad. It should be negative, if you ask me. But you never know how these markets work. So we'll see. But to make no mistake, look at it. Hiring slowed as February as uncertainty created as ADP data. So you can tell right here, looking at this. Look at this. Wall Street expectations, concerns that the economy is losing steam. And this is private sector. So private sector is not doing well. Look at this. US private sector employment tumbles in February. So if you look at it, this is 575. This is in 2022. And it's just been going down since for a long time. And if you look at it, here is 186 last month. Now it's 77. Doing very, very poorly. Definitely a downshift right now. So you can see that. And then look at this. I pulled up this article, and Goldman Sachs is now laying off people. And this is why you can see a really bad economy. And you're going to see QE. Oh, Goldman Sachs, VPs, underscores on the chopping block. So Goldman Sachs is not doing well. They are on the chopping block, and these are good paying jobs. Being a VP at Goldman Sachs, you can't claim that this is like they're laying off lazy. So a lot of good paying white collar jobs are being, and that's really going to hurt. And you can tell with it's not just the data, but look at this. Macy's misses on the mark of sales growth, warns on profits as it challenges growth with tariffs. But so Macy's is not doing well. And look at this. Macy's is joining a growing list of major retailers issuing weak outlook. They say Trump tariffs, but I think it's wary consumers too. Tariffs alone wouldn't just really drive up costs. There's other things involved. Supply chain, monetary inflation, uh, but yeah, it's a growing list of retailers. This week's soft guidances: Best Buy, Target, and Abercrombie and Fitch. So those are more than one retailer that's not doing well. And then look at this. This is tech. Marvel Tech, worst drop since 2001. Disappointing forecasts. So their Marvel Technology stuffing. Look at this. Revenue forecast fell short of the highest estimates, disappointing investors looking for a bigger payoff in the AI boom. So you can see the AI boom is not doing well. It's failing. Future or not, just because it's future doesn't mean it's good. And the AI boom's not doing well. Future also can become the past very quickly. But what's once the future is now the past. And that might be the theme with AI, if you ask me. So you look at it, Marvel, who should be benefiting from this AI, you want more proof about how bad the economy. Look at this. 401k has become America's rainy day fund. More workers are tapping into the season to the savings to avoid foreclosure and pay medical bills. Now, what I would do, people would say I'm crazy or insane or dumb. I would actually just allow the 401k to be just like a regular account. It's like this is an investment, this is a retirement account. Companies can have matching or whatnot, but if someone needs to withdraw from it, they should be able to withdraw from it without paying back. And that would actually be a way of propping up the economy because then they would just start withdrawing from their 401k when they need to. They don't have to use it for retirements. So uh, I would actually rewrite that law. And then that way, it's like getting a pay raise without getting taxed. And then when they withdraw, just, they pay a tax. Uh, so, or they can make it like a brokerage account. They can withdraw it, and then they'll just have capital gains taxes. I don't see why not. And then it still could be a company benefit because you have matching. It comes from your check tax free. They can sell it as a capital gain. I mean, I'm not saying it's perfect, but in the situation we're in, this would give people a bit availability to pay off bills and whatnot as a way of propping up things. So financial emergencies pushing more and more Americans to break into their 401ks. So, and then if you look at the market, retail gambling is fading. Retail share and options, so they don't have enough money. They cannot, they cannot buy stocks. So look at that right there. Stock, just like the stock market's gone down. And here's the other thing, just going through. Wall Street Bank says markets are flashing rising recession risks. So Wall Street banks, they're not doing well. You can tell with Warren Buffett. Warren Buffett is grabbing cash. And even the Fed's Harker, look at this, says warning signs emerging for the US economy. So no one's really that bullish on the economy. You can see all the cracks are following. The data is starting to look like reality. And QE's coming back. That's what it is. So the US, we're headed towards recession. So anyway, that's all I had to say. I'm gonna have a couple more. I'm gonna do a gold precious metals video. I had so many articles piled up that I just decided to skirt them out and do themes, and I just wanted to get all the economic articles out today. There's a gold one. There's some gold stuff that I found very interesting that I'm gonna share tomorrow and maybe some other days. And there's a crypto video I might do over the weekend, especially with the pump and dump known as the Bitcoin Reserve. Especially the tweets out, doing them on Sunday afternoon when most thinly traded market. So anyway, that's all I have. Remember, not financial investment advice. Read below. Talk to you next video.